me before at Samaritan events. And for this gifting and strategies webinar, we were excited to have Tim Doolittle from the Willatus Law Firm join us for some of the legal strategy. So in talking with Bonnie and in reviewing some of the different ways that donors can benefit nonprofits, it was apparent to us that some of the old tricks aren't necessarily known. And in the tax law changes of the last few years and the CARES Act and the Tax Cuts and Jobs Act, there's been a few new ways to give that have been opened up that not everyone knows about. So we thought it would be important to highlight some of those, as so many of you benefit the hospital and other nonprofits, and you want to find ways to do that that are efficient for yourself and perhaps allows you to give a little bit more. So I'm going to touch on a few things and pass it over to Tim for some of the more complex gifting that you can do. But what I'd like to do is share my screen and just through a few things, few strategies you can use for gifting. So I think everyone can see that, and I just need to move everyone's face to the left side of my screen so I can navigate. What we'll be going over in short, I'll cover two of these. Tim will cover most of the rest. An outright gift, I'll highlight several ways, I'll focus on the in-life gifting that you'll have, and Tim will focus a little bit more of the complex, still in life, but legacy gifting as well. So the outright gift and the donor advised fund will be two areas I cover, and Tim will touch on wills, trusts, charitable trusts, etc. And I just like to say that for anyone interested on these fact sheets, I'm just going to throw a few of them up. You can absolutely get copies of these after the presentation. But if there are no questions to start, I'll just get into my first so we can get the information out there and field some questions afterwards. The first area of gifting I'd like to touch on is gifting appreciated stock to charity. Many of you may have started investing many years ago outside of retirement accounts, your own taxable investment, or for many people, we see it all over the place. Your grandparent may have gifted you stock they've owned since the 30s or 40s, and you have this nice stock position, but the cost basis on it is very low. The investment has grown a lot over time, and you have charitable intent. So one of the powerful ways to give is to give that stock to the charity. Samaritan accepts gifts of stock all the time. And so just as an example, to highlight this, I'll start with perhaps donating $10,000 in cash, as so many of you give cash donations. Well, there, and the fact sheet assumes a high tax rate for a high earner of 35%, but the illustration holds that you get that deduction off the top line in your taxes, and it does save you some on taxation. Sort of the least efficient way would be to sell that security that you invested in so long ago and give that cash to the nonprofit, to Samaritan. You'd have, yes, you'd get that $10,000 off, but you'd unlock, in this example, $1,200 in capital gains tax from selling the stock, leading to a tax benefit of $2,300 less than the $35 in the example of cash. The best way to go, if you have that appreciated security, rather than reach into the checking account to make that donation, is give stock. If you have the stock, $10,000 worth, you get the deduction you save on taxes, and you avoid capital gains. The hospital, the nonprofit, they're not paying that gains tax. They're a nonprofit, so they get the full market value of that gift. You get that deduction, so it is a win-win to go into a cap to give that donated stock. Another avenue in gifting is the IRA. And in estate planning, generally, if you have different buckets of assets to give, sort of the first place you want to look if you don't need that money is the IRA. It's very powerful from a beneficiary status to give that IRA upon your passing to a nonprofit. They receive the full value of that IRA, as opposed to your heirs, if they were to receive that IRA and you were to give the taxable side of your estate to charity, under a new law passed in 2017, you now only have 10 years to empty that IRA. So, especially for those that have built up a large IRA over time, that gift, say to your son, daughter, grandchildren, that now needs to be emptied out within 10 years. That brought forward that taxation for them from over their lifetime to a 10-year window. They might see, especially for large IRAs, some significant taxation out of that. Better yet, if you have charitable intentions, name the nonprofit, name Samaritan on your IRA, and they'll receive the full value of that. In life, there's another strategy for gifting that can be pretty powerful. Many of you have saved over time. Your IRA may have more assets in it than are needed for yourself, and for some of you, may dread that required distribution every year. That can be a large chunk of money for big IRAs. If you don't need that RMD or have intentions of gifting even above that RMD, when you hit age 70 and a half, you can begin to give gifts directly from your IRA up to $100,000. That can be the RMD, less than 100,000 or up to 100. There are some best practices for that. You want to make sure it's a registered nonprofit and write a check from the IRA. But that's another powerful tool. You, instead of, if it's a $50,000 RMD, for example, if you give that as a qualified distribution, that's $50,000 of income. It does not raise your income. You're not being taxed on that. Further, for those that are subject to the AMT, it actually is not even raising your income for the AMT. You're just sidestepping that altogether. So that can be a very powerful tool for gifting in a way that many clients have started to do, but it's not a well-known practice. So we wanted to highlight that. And again, I'm not going to read through the bullet points, but these fact sheets are available if anyone would like to see them afterwards. And sort of the last topic I'll touch on, and I'm hoping we're giving you information that'll raise some good questions, is the idea of bunching gifts and the donor advised fund. With the 2017 Tax Cuts and Jobs Act, there was the increase of the standard deduction for a married couple. It now sits around $25,000. For many, many people, their normal charitable deductions under the previous setup allowed them to itemize deductions and get a charitable or a tax deduction for their charitable gifts. Well, now that hurdle, especially with the cap on the state and local tax deduction of $10,000, is much higher to get to a point where itemizing makes sense. One strategy, and I'll go through the numbers here quickly, is bunching your deductions. So what you can do, couple one, it runs through the scenario where they're giving $12,500 each year. This is over a 4-year period. Instead, and they're receiving no additional deduction on their taxes because they're electing the standard deduction. They don't have enough, even with that 12.5, to get over that standard deduction. Well, couple two, instead of giving 12.5 every year, gives 25,000 in 2 of the years and 0 in the rest. For that year where they give 25,000, they're getting up over the standard deduction. And you can see cumulatively here, I don't know if everyone can see the little type here, but over the course of those 4 years, the difference in what you would count as your deductions, and this includes some high tax earners, but so the numbers would be different for everybody, but 22,000 almost in difference from bunching those and getting that higher deduction. One of the powerful ways you can do that sort of bunching is through a donor advised fund. And certainly just with the donor advised funds and some of the things that Tim will talk about, there's a lot of nitty gritty to these. We'll touch on the highlights and are happy to have the conversation more in depth either through questions or offline. But the donor advised fund is a fund you can establish to, it's donor advised, exactly as it says. You can put cash or non-cash items, securities, even real estate, and some privately held stock in a donor advised fund. You get the benefit of your gift. On the sheet here, under the normal rules, you can give up to 60% of your adjusted gross income for deduction each year. Under the CARES Act and extended into 2021, you can actually do up to 100% of your adjusted gross income and for cash contributions. And on top of that, there's a 5-year carry forward. So if your income adjusted gross is 100,000 and you give 500,000 to this donor advised fund, you can carry forward and reduce that income for 5 years going on. If you give stock into the donor advised fund, that gets up to a 30%. So if you were making that 100,000, you could put 30,000 of stock of non-cash items into that donor advised fund to get that deduction for the year. That is also has the 5-year carry forward. So again, a larger gift, you could still benefit your taxes in years to come, and you can combine them. You can do it's called stacking. You can do the 30% of adjusted gross income with non-cash and then top it up with cash deductions or cash contributions. This donor advised fund is something that you can see the balance grow over time. It can be invested. The donor advises. You don't necessarily have the power to point everything from, but any donor advised, just about any donor advised fund custodian will take into the advice of yourself or your heirs. If this fund lives on past your lifetime, you can elect your heirs to continue providing that advice on what charities should receive contributions. So if you make, let's say, $100,000 contribution into a donor advised fund, you can then work with the custodian of that fund to make your contributions to charity each year. It can be $1,000 check goes here, $1,000 check goes there. Larger amounts, you can continue to contribute to it over time, and it can be invested. You can direct how it is invested. So that's a powerful tool for gifting. It fits right in with that bunching strategy that you can give larger one-time gifts to bring in that charitable deduction that's now lost to the standard deduction. So I think I did a pretty good job of keeping this within 15 minutes, but I will hand it off now to Tim Doolittle from the Willatus Law Firm to touch on a little bit more of the complex gifting strategies that are out there. So with that, I'll say, take it away, Tim.
All right. Thank you very much, John. I'm also going to share my screen to a PowerPoint presentation. Let's see here. Let's see if this works. I think it's going to work, which is great. So yeah, I'm going to talk today about some estate planning strategies to do with charitable giving. Just as a brief introduction, I'm an attorney with the Willatus Law Firm. We're a firm with 8 attorneys here down in Syracuse, New York. We do have an office up in Watertown. We focus mostly on, I do estate planning and trust work here. We have commercial real estate, residential real estate. We have attorneys that do corporate work, litigation, and also we represent a number of banks and commercial financing transactions. That's just a brief overview of the law firm and what we do here. I am an attorney, of course, so I'm going to have a disclaimer on the front of my presentation, just saying that, we're not forming an attorney-client relationship. None of this is considered direct legal advice to any of the attendees here. And you should always contact your own attorney relating to your specific situation, and not rely on this presentation. So very basic overview of the basic documents you should have in estate planning. First and foremost, every person should have a last will and testament, and we'll talk about how this is going to interplay with your charitable giving strategy in a moment. Power of attorney document is a very important document to have because we want to protect against the possibility that an individual may lose their capacity and lose the ability to manage their affairs. The power of attorney is appointing somebody to be able to act as you with regard to your legal and financial transactions. If you are charitably inclined and have a power of attorney in place, you want to make sure that that power of attorney allows your agent appointed under the power of attorney to continue your charitable giving. You may have to make a specific authorization to your agent to do so under that power of attorney document if you want the charitable gifting to continue. The healthcare proxy would be the same thing, but we're talking about medical decisions here. It's appointing somebody to be able to act as you with regard to your medical decisions in the event you lose your capacity to do so on your own. Finally, the last basic document that we prepare for all of our clients is the living will. That's basically your end of life medical treatment document. It's where you say, if I'm in a situation where I lack brain activity, I'm being kept alive by artificial means, maybe 2 doctors have determined that that's going to be it for the rest of my life. You can make your personal declaration to your family and doctors about what you want to have happen in that situation. Either remove that artificial life support or keep me on it. And that's a good document to have just so your family knows what your choice is. Finally, revocable trust. You see I have a question mark after that. Not applicable for every situation, but it is something that comes up more and more. You use a revocable trust basically to avoid the probate process for your assets that may go through probate otherwise. It can be used, if people want to keep their affairs private and not going through the court system. It can be used if you have properties in multiple states and want to avoid the possibility of having your family go through multiple probate processes. For instance, in New York, and then you have a condo in South Carolina and a condo in Florida. If those are all in a revocable trust, they can all just be handled by the trust versus having a probate open in New York, then ancillary probate open in South Carolina and in Florida. Can also be beneficial from a charitable point of view, because if you name a charity in your will, you're supposed to include the New York Attorney General as part of the probate proceeding, which usually isn't a huge deal, just adds another party that's involved in the probate proceeding. So you may think about using a revocable trust to help carry out your charitable gifts at the end of your life as well. So using a will to make charitable gifts. First, you're going to be sitting down with your attorney, talking about what your goals are for both leaving things to your family and to charities. The one guidance I have to individuals is always please be specific with how you want your gift to be made to a charity. If you want to say it goes to St. Jude's Hospital down in Memphis, Tennessee, that's fine. We always prefer that it stays local, but if you have specific desires for the funds, you need to make those terms known to your attorney so that they can include it in your will. You may have a donor advised fund that you want the assets to go to at a specific foundation. You may have a specific wing of a hospital that you want to benefit. You may have a specific sport that you want to benefit at a college. All these things you need to talk through with your attorney so that they can appropriately document your wishes in your will. Percentage giving versus specific dollar amount. I just like to point out to people that you may have in your head, okay, I'm going to leave $20,000 to this institution, $20,000 to this institution, et cetera, under your will. The problem with that is you never know how much you're going to have that goes through your will when you pass away. So it could be a good idea, instead of naming a specific dollar amount, just saying, okay, I want to leave about this percentage of my estate to that charity. And that allows it to be a little bit more flexible so that, for instance, if you have $40,000 of charitable gifts, but only $30,000 is going through your estate, then all of a sudden, there's not enough there for those charities and there's nothing left for your kids, if that's a desire of yours. So I always advise that percentage giving is used. And that goes along with the bequest versus residuary gifts bullet point as well. Bequest would be that specific dollar amount versus putting the percentage in the residuary clause, which is just the bulk of your estate, and how that's distributed. I would like people to be wary that they may have very old wills that contain specific formulas relating to estate taxes that may have been in place at the time they created the will. So way back when, not too long ago, but way back when, the estate tax exclusion was $1 million. So there could be a will out there that says, I leave everything above the estate tax exclusion tax charity, which if it was $1 million back in the day, anything above $1 million you want to go to charity, great. Now the estate tax exclusion, federally speaking, is over $11 million. So that formula may be in place, and you may have all the intention in the world to leave something to charity, but that will formula will not allow that gift to be made to the charity because everything will be under the estate tax exclusion amount, perhaps. That leads into the next bullet point, that if estate taxes are an issue, any gift made to a charity under will offset, the amount of state taxes due, which is a great benefit. So charitable trusts. This is a very complex topic. It's tough to go over all the ins and outs of it in a short presentation, but I've tried to include kind of an overview of the main charitable trusts that are used, which are charitable remainder trusts and charitable lead trusts. These are an excellent way for those that are charitably inclined to achieve their philanthropic goals, but also gain the ability to perhaps use the property for the rest of their life or leave the property to their beneficiaries when they pass away. It can also have the effect of reducing your income taxes or the gift or estate taxes that might be due upon the transfer of property. Donor advised funds can make these charitable trusts very flexible. These trusts are irrevocable by nature. So if you do name a specific trust as the beneficiary, it's going to be pretty difficult to change that charity. So if you do have a donor advised fund, you can name the donor advised fund, and then that would be the beneficiary, the charitable beneficiary of the trust, and there would be more flexibility down the line to change the actual grantee of those gifts that are made. So first, a charitable remainder trust. This is a trust that's created by an individual that's going to contribute the property to the trust. When you donate assets to charitable remainder trust, you're going to receive an immediate income tax deduction for the remainder interest of the property in the year that the trust is funded. The trust is going to make payments to one or more non-charitable beneficiaries. So it's called a charitable remainder trust because once the time period of those payments expires, the charity is the remainder beneficiary of that asset. So the time period is usually going to be for the life of an individual or for a predetermined number of years. Typically speaking, we see these where it's set up for the life of the person setting up the trust. They're the beneficiary for the rest of their life based on a set percentage that we'll talk about in a little bit. And then once they pass away, all the assets then flow through to the charity. So this is used a lot when you have a highly appreciated stock and you want to avoid the capital gains, but want a charity to benefit from that. So a client can donate a highly appreciated stock to a remainder trust, capture that immediate charitable income tax deduction. And then once the stock is in the trustee can sell the stock, which they don't pay capital gains on because the remainder trust is exempt from those taxes. And then they can reinvest all those assets into an income producing asset to benefit the client who's going to receive that income for the rest of their life. They will have to pay some capital gains, but it will be deferred based on the amount of income that they're receiving every year. This is very beneficial for a number of reasons. If the client simply sold the stock and reinvested into an income producing asset, they'd have to pay those capital gains immediately upon the final sale. The fact that we're moving it into a remainder trust allows for more of the assets to be invested, which will in turn produce more income that can be turned around to the client to receive for the rest of their life. Now there's two types of ways you can take the income from these remainder trusts. You can either do what's called a unit trust, which is when you choose to receive a fixed percentage of the fair market value of the trust assets every year. So you'd have to recalculate what the value of the assets are every year. And because of that, the income will fluctuate. Usually you're taking, 5 or 6% of the trust assets every year as the income. You could also choose to do an annuity trust. This is for the clients who just want to say, I want a fixed amount. I don't care about, if the asset goes up a lot. I don't care about that. I just want to make sure I get this fixed amount that's going to come from the trust every year. So in that case, you would do a fixed percentage of the fair market value of the asset at the time of the gift. And again, it's usually about 5 or 6% that the individual would take. So now we can talk about charitable lead trusts. And this is kind of the opposite scenario of what we just talked about. Here, the charity is the lead beneficiary of the trust, which is where you get the name lead trust from. The trust is going to make those income payments to the charity for a term of year. Could be for the life of the donor or for a fixed term that's spelled out in the trust document. Once the trust term expires, the trust assets are then distributed to a named beneficiary, which is usually going to be either the creator of the trust or the children of the creator to pass that asset down to the next generation. Now, there's two types of lead trusts you can create. Grantor lead trusts, which are trusts in which the grantor retains certain powers and the income is still taxed to them. This is useful for donors who want to accelerate the deductions that they may have from a multi-year pledge that they've made to a charity. And this is usually used when somebody has a significant income event that they want to be able to offset with a charitable deduction that's made over a number of years. So let's say a client has a big income tax bill. They already have this pledge to make $50,000 per year over the next 5 years. Instead of doing that $50,000 deduction each of the 5 years, they can transfer assets sufficient to cover that $50,000 transfer to the charity every year. And then instead of the deduction being over 5 years, they can take all that deduction immediately up front when they make the initial gift to the trust. When the term ends, the trust assets are then returned to the client. The other option that we see with lead trusts are non-grantor lead trusts. Typically, this structure is used when you want to achieve a reduction or potential elimination of a transfer tax of gifting, some big asset down to the next generation, whether it's a family business, whether it's some stock that you want to get down, whatever it may be. You want to gift that to the next generation and try to avoid the gift tax as much as you can. Since the remainder beneficiary is non-charitable, there could be a gift tax owed at the time that the gift is made. The value of the gift is going to be reduced, however, by the present value of the income stream that passes to the charity. And that present value is calculated using software that people will use. And it's going to be based on the IRS 75/20 interest rate that's published by the IRS every month. The lower that rate is, the better it is for our clients to get a better deduction from that gift tax. This is a great tool to use if the client anticipates that the asset's going to quickly appreciate over the term of the lead trust, because you take that present value deduction on the eventual gift made to the beneficiaries. But if the asset grows exponentially beyond that, then we have a great result of the asset getting to the next generation without paying the gift tax. And they also received some gains outside of their estates from that. Again, the client's going to choose for the charity to receive either the unit trust, fixed percentage of the fair market value of the trust assets every year as the income for the charity, or they can choose to do the annuity, in which case it's a fixed percentage of the fair market value at the time of the gift, which would be a steady income stream to the charity. So that was a brief overview of charitable trusts. Very complex topic. Really something you should go over in specifics with your attorney and CPA and financial advisor to get through the, drill down the basics or specifics of details of what your situation is. Next, I'd like to talk about just, options for gifting real estate potentially to charities. And the first thing I should say is that you should check with the charity and make sure they want to receive the real estate. A lot of times a charity may not want to receive the real estate for many reasons. But if they are open to it, you can talk about gifting real estate that maybe you have highly appreciated value in. So first, just an outright gift. Conceptually, this is very simple. You're just writing a deed, turning it over to the charity, working with a CPA to get the appraisal, and submitting all the forms to the IRS to get the determination of your deduction for the fair market value of that gift made to the charity. And you would avoid all the gains that have built up in the property. But let's say, maybe it's a vacation property you want to be able to use for the rest of your life. In that case, you could make a gift to the charity and retain the life estate in that property so that you can use it for the rest of your life. You will get a lesser deduction because you're retaining that use of the property for the rest of your life, but you'll still get a good deduction at the time of the gift made to the charity. You can always end this by, donating the remainder interest to the charity, or by agreeing with the charity to sell the property. They get their share that you've already donated to them, and you get your life interest share that would be calculated based on your age at the time of the gift. You could do a bargain sale to a charity, selling the property to a charity at a discount. It allows for smaller gains to be realized by the donor. The gift piece of the sale is going to be tax deductible, and potentially you could take back a portion of the sales price as an annuity from the charity so that they're paying you monthly or yearly, whatever it may be, for the proceeds of that sale. Finally, a little bit more complex way to do that would be to use a charitable remainder trust for donating the real estate to the charity. You would do a flip unit trust in a way, in that you would receive any income that's produced by the real estate while it's still in the trust. If the real estate is ever sold by the charity, or by the trustee, I should say, it would then flip to a standard unit trust where you would receive a fixed percentage of the market value of that asset out to yourself, and the remainder, of course, would go to the charity. So whether you have small or large intentions with regard to your charitable goals, planning is very key to making sure that your goals are met. Make sure that you're talking with your financial advisor, your attorney, your accountant, so everybody can be on the same page, and make sure that your plan is being fulfilled to the best of your desires. And that's all I have for my presentation. So I'll stop my screen share.
Very good. Well, thank you. Thank you very much. So does anyone have questions? That was a lot of information. Thanks, John, and thanks, Tim. Feel free to use the chat or go right ahead and ask your question here.
This is Jim Rafferty. John and Tim both, would it be possible to get the documents that you shared with us? I don't know if you could send them to Bonnie. I think Bonnie has all of our email addresses, and could just forward it in one email to all of us. If you'd be willing to do that, I sure would appreciate it.
Sure, I'd be happy to share the documents that I have.
Yeah, I'd be happy to share the PowerPoint with you.
Yep,
Okay,
I'll send that out to all the attendees as a follow-up, for
Okay,
sure.
question for Tim. When you were talking about the charitable remainder trust, that they're, I don't know if you say irrevocable or irrevocable, whichever word you use. Is there when you establish a trust like that, is there a time, a clock that ticks? I know my wife and I established one of those trusts several years ago, and our attorney said, don't forget, folks, there's a 5-year ticker on this before it really comes into play. I just wondered, is that a different sort of thing, or is there still a time limit before it's really the trust?
So you're talking about the 5-year look back period for Medicaid, which is
I see.
kind of
Yes,
different than
I guess that's
planning.
what it is. Yeah.
Yeah. So you're talking about, if you make a gift, you have to wait 5 years for it to be cleared from your name before Medicaid won't count it against you.
Okay.
Good question, though, Tim.
Yeah.
Very good
Very
question.
good.
5-year always comes up. It's always in the back of people's minds.
Yeah.
Yes.
And I will say
definitely.
something Tim touched on early about possibly having a revocable trust, especially if you have multiple properties or avoiding probate. One thing we've seen over the years is you always want to make sure you have to retitle everything into the trust. If you just create the trust document, unfortunately, we've seen this too many times, but the house in Florida doesn't get renamed into the trust, well, you're going to have a probate issue because that never got put in the trust. So if you do create a revocable trust, make sure to retitle everything.
That's a good point.
Yeah, our attorney made that point several times, and as a matter of fact, gave us a sheet and a half of paper typed that said, when you do something like this, this is the title you want to use, so don't forget about it.
That's a good attorney.
Yeah.
That's a very good
Very
attorney.
good. Oh, very good. Any other questions?
Yes, Bonnie, this is Steve. I got a question for John on the IRA distributions to meet the RMDs.
Yes.
It's very important, right, that the flow of the funds has to go direct from the manager of the IRA. straight to the charity.
Yes.
In other words, if I've got my money with RBC, I got to call Christine and say, do this. Don't send the money to me first and go through my bank account, but straight from the manager to the charity.
Yes, you are absolutely correct about that. And that's a very important and great point, Steve. You want the money to go directly to the charity. That's the only way that works. We often say that check writing directly off the account, either calling an advisor and having them send the check directly, or if you have checks that you can write on behalf of your IRA, write that out to the charity. It must be cashed by the charity by December 31st. So I know many charities are open all year long. Some decide to take that last week of the year off. You're going to want to coordinate with them before you make a last minute decision to do this. So it must be cashed by December 31st. That's another important distinction.
Yeah, I think it's a great educational tool for us. In fact, I think we should be pushing this, across the board with our donor prospects, because I don't think a lot of people realize it. And, so many people are trying to self-manage these days. They might lose sight of this.
Yes, Steve, and that's why we wanted to put this on, because you attended the last one as well. You're always a good asker of questions and pertinent information as well. But there is so much, and for some of these, especially on the stock side and the donor advised IRA, that's a little simpler topic. There are a few rules here and there you must keep in mind, but especially with having Tim for the estate and some of those lead trust conversations, you're going to want to make sure you loop in some professionals on any of these items, because you want to get good advice on it. And that's true for the charitable stock gift and the IRA, but also especially the trust side of it. You want to contact your tax and legal advisors.
Absolutely.
Also got one for Tim. I don't know if you can answer it or not, but with some of the more complex setups, the trusts, do you have any kind of a rule of thumb, Tim, as to the size it'll make sense to with the costs that are going to be incurred?
Sure. I mean, like you said, it's difficult to answer because it is going to be very specific to the client situation. It may be that they have a specific case where it makes sense to do one of these trusts. Like I talked about, maybe they have this huge income event that they're trying to take a deduction on for some reason, or they have this asset that, they just have a startup and it's going to be bought in the next 10 years. And they want to get that down to their family before it's bought. That's when you use a lead trust type thing. So if you have charitable intent and you have potential estate tax issues or gift tax issues or a large income tax bill that you want to avoid, that's when you want to be talking to your professionals and seeing if, the remainder trust or lead trust would make sense, or if you could just do, a gift outright, if that makes more sense.
Okay, thanks.
Welcome.
John and Tim, do you anticipate big changes with the new administration coming in and the proposed tax changes? Because some things changed with the 2017 bill. Do you anticipate a lot of change or minimal?
I would say it depends on what the senator from West Virginia wants to do. Is that Joe Manchin?
Yeah.
He's in the past, he's been very opposed to the estate tax in general. So I can't see him voting and going along with lowering it to $3 million or whatever the Democrats are talking about these days. But it's certainly something you want to be aware of. It's a hot topic in the estate planning community for sure. There's talk about them potentially making it retroactive as well, which is very concerning. I don't think that they would do that. Again, I don't think that's fair. And I don't think that a bunch of the Democratic senators would want to go along with that. But if you see the Democrats eliminate the filibuster, it might be a sign that they're going to go for it. If you see them preparing a new reconciliation bill, you may see something included with the estate taxes in that. But again, they need to get all 50 senators on board, and I think that's going to be difficult for them to do. Do you have any thoughts?
From
Yeah,
what I've seen,
Go ahead, John.
oh, I'm sorry, Mary. I was just going to echo what Tim said, and from what I've seen from some of the professionals in the investment community, while that may be a difficult political win for them, it might be one of the easiest on taxation. It may give them it doesn't change a lot in the federal budget, but it gives them a big political win that, hey, we took it to those with the large estates. So it is, as Tim mentioned, a front burner issue that there's a lot of talk about. So I would keep an eye out for the reconciliation or the lack of the filibuster.
I mean, $10 million is not a lot of money when you're trying to value a family farm, for instance.
And that's one of the first things that is brought up when people talk about estate taxes on the political level is, the family farms. What do we do about those?
Sure.
So, and it's definitely a concern. So keep advised yourself. I'm sure you do if you're attending a presentation like this. And also be sure to keep in touch with your attorneys and advisors that you work with to make sure that you're staying on top of things.
I think these seminars are very important. After the last one we did a couple years ago, we went in and had our will updated. So thank you.
Good.
Thank you for doing this.
Absolutely.
Definitely. Any other questions from anyone? You could use the chat box if you're more comfortable. No? Okay, well, if there's no more questions, I think we could probably wrap it up. Any final words, John or Tim, to take us out? It was a wonderful presentation, lots of great information. So thank you again for doing this for us.
It's our pleasure. And as we can help anyone, if you have specific questions, you can contact Tim or myself. If you're going to go through any of these procedures and you have other advisors, we ask that you certainly loop them in on this. There are some, as Steve pointed out, some complexities, even in seemingly the simple ones, the gifting from the IRA, that you want to be mindful of as to do them correctly. They're in the law, but you got to follow that law to get the full benefits. So we'll continue to hopefully put some of these on to educate the donor community in this area, but certainly as things change, as Mary pointed out, the estate tax may get lower. That's sort of a high target in the tax game right now. So that would open up a host of issues and a lot of business for Tim. But we are happy to give these presentations, and however we can help answer questions or help spur on some giving, we are happy to do.
Yeah.
Yeah, I'd just like to thank Bonnie for organizing this and John for inviting me, and thank everyone for attending. And always feel free to reach out with any questions. You'll have my contact information in the PowerPoint that's sent along. It's in the second slide. So feel free to reach out with any questions you may have.
Yeah.
Thank you very much.
Yeah.
Thanks for your
very
time.
good. Yes, thank you. Thanks
you
everyone
all.
for
Thank
attending.
you.
So
Have a
look
good
for an
day.
email from me with all the follow-up information. I'll send that right out. So
Okay.
thanks very much,
Excellent.
everyone. Have a good
Take care,
afternoon.
everyone.
Bye-bye.
Thank you.
Bye-bye.